Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today, as Natalie mentioned, we are taking a look at financial earnings, which are coming out fast and furious right now. And today we're taking a look particularly at the manufacturing sector, in particular WITCO, West Indian Tobacco Company Limited, as well as Trinidad Cement Limited. Now, both stocks would have fared not so well in the particular COVID restrictions, as well as a generally lower economic activity environment over the past 6 months, in particular their second quarter or second calendar quarter, that is, and that would have been reflected to a large degree in their financial earnings results. So let's take a look quickly, and we're switching to our first slide, which would be WITCO, and for the half year ended June 2020, WITCO reported an earnings per share figure of 77 cents, which was a 7.2% decline from the 83 cents recorded in the prior comparable period. Now, revenues were down just around 10.3% from 470 million to just around 421 odd million. Our gross profits were down a comparable 10.6% from 366 to 327 million. Overall operating profits declined just around 7.5%. From that $300 million mark to 277, and profits after taxes also very similar in terms of that decline of around 7.9% from 210 to 194 odd million dollars. Now, the revenue story has really been the main driver of WITCO's performance, and we can see that after a very nice uptrend from the half-year period of 2017, whereby in 2018 revenues increased by 11.7%, and in 2019, that the comparable period, revenues increased by 3.2%. Well, there has been that 10.3% decline in revenues overall, reversing that trend that was observed and enjoyed by investors over the past 3 comparable periods. So that really has been a trend that would have been broken majorly because of the effects of COVID, shutdowns to bars, and other facilities that would typically promote the distribution and sale of WITCO's tobacco products would have been closed for extended periods of time, and that would have weighed on the revenue generation. From an operating perspective, however, WITCO remains a model of efficiency, as we can see in terms of their gross profit margins. That has hovered at around just the between 77.3 and 77.7% over the last 3 comparable periods. On an operating basis, there has been increases in efficiency, where the operating profit margin has increased from 62.1% in the first 6 months of 2018 to 65.7% in the most recently concluded period. And profit after tax margins have also improved from around 42.5% in 2018 to the current level of 45.9%. So again, WITCO is a model of efficiency, and that bodes well for the company and would provide some reassurance to investors that the company is pretty much on top of things despite the more challenging environment that is being faced. So at the current price of $35, WITCO is trading at a price-to-earnings ratio of just around 22 times, which is slightly above its manufacturing sector average of 20.8 times, but does offer a fairly attractive dividend yield of 3.4% in comparison to the 1.8% offered by the rest of by the sector on average. So on the basis of fair valuations, good cost containment initiatives, but again, with that outlook mired by COVID-19 uncertainty and in particular demand pressures, Bourse maintains its neutral rating on WITCO. Now turning quickly to Trinidad Cement Limited. For the half year 2020, the group reported a loss per share of 0.7 cents, which is a fairly deteriorated position from its 3.5 cents profit for the comparable period back in 2019. Now, in similar vein to WITCO, there was significant declines in terms of revenue compared to the prior comparable period. We see a 10.6% decline from 867 odd million to just around 775 million. Gross profits did decline also 15% from 282 million to just around 238 million. Operating earnings declined 8.5%, and overall net income declined 68% from $33.4 million to $10.4 million, and that was driven by rising financial costs, among other factors. Now, again, the revenue story has been fairly challenging, like other stocks in the manufacturing sector, well, most stocks. And we can see that cement sales were down just around 10% from 820 to 748 million. Concrete sales were also down from 37 to 26 million. And that would have really, those are the two major drivers of revenue generation for TCL. From a profit margin perspective, at the operating level, there has been a reasonable degree of consistency, and we can see that that operating profit margin has hovered in those green columns at around the 14% level over, over the past three comparable periods. That profit before tax margin, however, would have been on a downward trend over the past 3 years from 9.7% to its current level of 6%, and profit after tax margins down to 1.3% as well. So some need for arresting that those efficiency declines, and work to do certainly. And with the outlook for regional and in particular local demand, there are certainly headwinds to growth in terms of revenue generation for Trinidad Cement Limited, like most other manufacturing stocks. So on the basis of that declining profitability, the fairly inconsistent dividend payments, and dividend payments have only been made about 2 times in the past 10 years by TCL, as well as that significant level of uncertainty driven by the COVID-19, Bourse maintains its sell rating on Trinidad Cement Limited at its last price of $2.10. Well, that's it for this week's edition. For more information, you can give us a call at 226-8773, email us at invest@boursefinancial.com, or check out all of our research on bourseinvestment.com. Have yourselves a wonderful investing week. This has been the Bourse Report.